Good day, everyone. How are you all doing? I hope wherever you are, you're having a good day. In today's video, I wanted to cover a very important topic that a lot of people, including myself, love to avoid, and that is the topic of crypto taxes. Now, why do we love to avoid this topic? And that's because we don't want to pay it. However, it's very important to actually face it head on, understand it, and get ready for it. And especially for me, what's especially important is to have it all in order and set up before the real bull run starts, because you don't want to be in a position where you're frantically trying to sort out your taxes while you're taking out profits and things of that nature. So this video is going to be mainly about that, but also we're going to have a look at the market. Obviously, Bitcoin it just doesn't stop going up, which is obviously good, and it's taking the rest of the market with it. So let's have a quick look at TA before we move on to taxes. This video especially needs to be prefaced with the age-old saying, this is 100% not financial advice. Please consult a tax expert when it comes to this for your own crypto assets and things of that nature. So definitely is not financial advice. And a bit of housekeeping, obviously, if you haven't already done so, subscribe to the channel, like this video, I would very much appreciate that. Also, if you're new to crypto, I've got a fantastic crypto course and a private Telegram group. A link for those two are in the description. With that out of the way, let's get the show on the road. So, looking at the Ethereum charts here, and I had sent this to my private Telegram group a little while ago, probably 2 weeks, maybe a little less. This chart pattern that was forming with Ethereum, nicely building up. It looks like an ascending triangle, but you can see there's a lot of accumulation going on over here, and it was leading up to the breakout, which has now happened. I outlined this important level of 474, which has been reached, broken and retested, and now the next target I had was 515, right? And that's literally just been touched. The reason I had that target is because if you look at previous price history, there was a nice, lovely spike up to that point. Potentially this is going to get broken now, and we'll head up to around 560 and above. So do watch out for Ethereum. It's doing exactly what it's supposed to do. I still think this is just the beginning of it, because Bitcoin has been taking all the limelight. It's been increasing at a very, very exponential rate, and Ethereum hasn't really broken out that heavily. It's been going up slowly, but not an explosive move like Bitcoin. And what normally happens is Ethereum follows Bitcoin's rally. So that hasn't happened yet. We had a small, obviously, breakout at the moment, but not to the extent that we're used to when it comes to following Bitcoin. Also, XRP is doing very, very nicely. Initially I had the 30-cent region as a target, and the next one would be 34 cents. So it's doing that. It's going up to the next level of 34 cents. That's the major level. And then we would want to see, as you can see, I highlighted these three regions. We want to hit 34 cents, but we want to then reclaim this as support. You can see here that 30 cents and 31 cents have been support in the past. If we can do that, then that's very bullish. We can then look forward to 45 cents and above. So the important part is to reclaim this as support. And then obviously Bitcoin just does what it wants right now. It's literally heading, it's basically a fraction of the all-time high, which is absolutely insane. I don't think anyone expected it to happen so early. beforehand, before this massive explosion around this price point, we would have just been happy to hit 15k for this year, but we're at 18, almost 19k, to $180 from 19k, and we've almost touched the all-time high. But as I've said, I expected a massive spike in the upwards direction from this breakout, but I thought that the retracement would come a lot earlier. It's obviously the way it's going on now, we're going to have a retracement potentially after we hit all-time high. But make no mistake of it, we will correct and retrace, and it will be a lengthy one. Think of this retracement. We had a massive parabola, and then we retraced for quite a while. That's how it normally happens, right? So expect that retracement, and then we'll reclaim support. As I said, I think 12.5, 11.5 is where I'll be looking at, but 13.8 is a potential support level as well. So let's see how that pans out. Now to the unfortunately boring part. What I'll do is summarize it for you now, and then if you want to read this with me, you can do. This is obviously for the UK, by the way, not for any other country. In the US, it's a lot more unclear as to what taxes you have to pay for the cryptocurrencies. But the summary basically is most people will have to pay capital gains tax, and that's 20%. And it's things like mining and staking, which are liable to income tax, which is up to 40%, depending on your other sources of income. And you have a taxable allowance of up to £12,000 of capital gains tax. Anything below that, you don't have to declare. Basically, anything above that, you will have to declare. So if you've got profits of over 12 grand, or maybe you're claiming capital gains for other things, like let's say you've got claimed £5,000 of capital gains, something else, and you've made 7 grand or over in crypto profits, then you'd have to claim that. So anything below 12k for this tax year and the last few tax years would be is the allowance. Anything below that, you don't have to declare. Anything above that, you have to declare. Also, very important, I spoke to a few consultants, crypto tax experts, and you basically want to stay ahead of the curve. So if you make a lot of crypto profits and you voluntarily declare your taxes, you'll be dealt with in a positive light. If HMRC or find out from Coinbase, who are now working with the tax authorities, if they find out through them that you have crypto taxes to pay, then you'll be liable to a much higher penalty of up to 70%. So you want to stay ahead of the curve. In terms of summary, anything else? That is pretty much it. There's the tax rules, the summary for the tax rules for this moment. It changes a lot, but for the most part, most people have to pay capital gains tax, and that's up to 20%. And it's better to stay ahead of the curve than to get prompted by the government, because then you have to pay much higher, capital gains tax or income tax or penalties. Also, in terms of record keeping, they expect you to keep your records, and if you don't keep your records, then it can be seen as careless, and that could also result in a penalty. So that's a summary, and now I'll start reading through the actual document from HMRC, if you want to stick around for that. So what crypto assets are, and it's funny that it's interesting that they call it crypto assets, because that's how I see them. The digital assets, the things you own online, you don't really use them as money, are cryptographically secured digital representations of value in or contractual rights that can be transferred, stored, or traded electronically. While All crypto assets use some form of DLT. Not all applications of DLT involve crypto assets. HMRC does not consider crypto assets to be currency or money. That's because they're not used in that manner. And that's why I don't really like the word cryptocurrency, because they're not. So they've identified 3 types of crypto assets: exchange tokens, utility tokens, and security tokens. However, the tax treatment of all types of tokens is dependent on the nature and use of the token and not the definition of the token. Exchange tokens are intended to be used as a method of payment and encompasses cryptocurrencies like Bitcoin. They utilize DLT, and typically there is no person, group, or asset underpinning these. Instead, the value exists based on its use as a means of exchange or investment. Unlike utility or security tokens, they do not provide any rights or access to goods or services. Utility tokens provide the holder with access to particular goods or services on a platform, usually using DLT. A business or group of businesses will normally issue the tokens and commit to accepting the tokens as payment for the particular goods or services in question. I think of like Binance token and things like that, which give you some kind of, discounted fees and things like that. Security tokens may provide the holder with particular interest in a business, for example, in the nature of debt by the business or a share of profits in the business. This is pretty self-explanatory. Security token is a security like shares in a company, or potentially things like bonds, right? Things like that. Which taxes apply? In the vast majority of cases, individuals hold crypto assets as a personal investment, usually for a capital appreciation in its value or to make particular purchases. They will be liable to pay capital gains tax when they dispose of the crypto assets. Individuals will be liable to pay income tax and national insurance contributions on crypto assets which they receive from their employer as a form of non-cash payments, mining, and transactions confirmation or airdrops. So most people are not really involved in that. The location of exchange tokens. HMRC considers that throughout the time an individual is UK resident, the exchange tokens they hold as beneficial owners will be located in the UK. HMRC has considered other possibilities, but at this stage in the development of these tokens has found that the residence basis most accurately fits the majority of transactions. This means a person who holds exchange tokens is liable to pay UK tax if they are a UK resident and carry out a transaction with the tokens which is subject to UK tax. Now this part is interesting because let's say you wanted to move to the Cayman Islands or Belgium and you change your residency to like the Cayman Islands. Potentially, again, this is not financial advice, if you became a non-UK resident and if you moved to the Cayman Islands and became a resident of the island, and then let's say you sold your assets there, I'm curious to find out if then you wouldn't have to pay any capital gains tax or things like that. Or potentially they have capital gains tax over there, but I don't think they do. I'd be curious to find out if that's the case. If that's the case and you're looking to make multi-million pound crypto profits and you live in the UK, then maybe you should think about moving to the Caymans. For inheritance tax, common law is relevant to the extent that double taxation agreements do not determine the location. Using the residency of the beneficial owner of the exchange tokens to determine the location gives a clear, logical, predictable, and objective rule which can easily be applied. Again, this kind of goes in line with that question. Potentially, if you moved to the Cayman Islands, something like that, and you became resident there, maybe you wouldn't have to pay UK tax. Income tax. HMRC taxes crypto assets based on what the person holding it does. If the holder is conducting a trade, then income tax will be applied for their trading profits. Only in exceptional circumstances would HMRC expect individuals to buy and sell crypto assets with such frequency. Basically what it's saying is you got to be buying and selling, the crypto assets probably in like the hundreds, like a ridiculous amount on like a daily basis, something like that. Because the people, the consultants that I spoke to, all of them said you're paying capital gains tax. And I'm relatively frequent in trading. I said a couple times a week. So again, the kind of frequency they're talking about, I think is going to be very, very high on a daily basis. So, but if you are in that bracket, then you probably have to pay income tax. Moving on, mining. So crypto assets can be awarded to miners for verifying additions to the blockchain and digital ledger. Mining will typically involve using computers to solve difficult math problems in order to generate new crypto assets. Whether such activity amounts to taxable trade depends on a range of factors such as degree of activity, organization, risk, or commerciality. If the mining activity does not amount to a trade, the pound sterling of any crypto assets awarded for successful mining will be taxable as income. And if the individual keeps the awarded assets, they may have to pay capital gains tax when they later dispose of them. They'll tax you at every avenue. Never forget that. Capital gains tax, which is the important part. HMRC would expect that buying and selling of crypto assets by an individual will normally amount to investment activity rather than a trade of dealing in crypto assets. In such cases, if an individual invests in crypto assets, they will typically have to pay capital gains tax on any gains they realize. Crypto assets are digital and therefore intangible, but count as a chargeable asset for capital gains tax if they're both capable of being owned and have value that can be realized, aka converted to fiat currency. What constitutes a disposal? Selling crypto assets for money, exchange. This part is the one that's just annoying because obviously as crypto investors you're buying and selling into different you're buying and selling from Bitcoin to Ether to XRP and all around, but every time you do that, that's a taxable transaction. So if you sell Bitcoin to Ethereum to USD to BAT, those are all taxable transactions. Using crypto assets to pay for goods or services, giving away crypto assets to another. If you send some crypto to another person, that's a taxable event or transaction. It's insane, but that's a reality. This part is quite important and makes it easier to calculate the tax. This pooling, basically, let's say you did a lot of transaction with Bitcoin, buying and selling, all of the transaction activity with Bitcoin, let's say you sold it to Ether and Binance token, whatever, all of that transaction involves Bitcoin will be pulled together, which makes it a lot easier to record keep and also for tax purposes. So let's read that quickly. Instead of tracking the gain or loss for each transaction individually, each type of crypto asset is kept in a pool. The consideration originally paid for the tokens goes into the pool to create the pooled allowable cost. For example, if a person owns Bitcoin, Ether, and Litecoin, they would have 3 pools, and each would have its own pooled allowable cost associated with it. So again, it's not about each transaction. Everything that happens with Bitcoin is one pool. This pooled allowable cost changes as more tokens of that particular type are acquired and disposed of. If some of the tokens from pool are sold, this is considered as a part disposal. A corresponding proportion of the pooled allowable cost would be deducted when calculating the gain or loss. Individuals must still keep a record of the amount spent on each type of crypto asset as well as the pooled allowable cost of each pool. And here's an example. So capital gains tax losses. If an individual, this is quite important. If an individual disposes of crypto assets for less than the allowable cost, they will have a loss. Certain allowable losses can be used to reduce the overall gain, but the losses must be reported to HMRC first. claiming for an asset that's lost its value. So this is very important because it actually helps. Let's say you go over the limit of the allowable cost, this can help to offset that, to kind of reduce that, so you have a higher amount. As with other types of asset, individuals can crystallize the losses for crypto assets that they still own if they become worthless or of negligible value. A negligible value claim treats the crypto assets as being disposed of and reacquired an amount stated in the claim. As crypto assets are pooled, the negligible value claims need to be made in respect of the whole pool, not the individual tokens. The claims will need to be blah blah blah. And record keeping, basically, you have to make sure to download all the transactions off the exchanges. If the exchanges get rid of them, then that is seen as careless on your part, and you could get penalized for that. So 21 minutes. So that's basically it. As I said in the summary, most people are going to pay capital gains tax in the UK, which is up to 20%. You got to make sure to keep record keep properly. And it's always better to stay ahead of the government if you haven't declared taxes, because if they do prompt you, and in time they will have access to everyone's crypto portfolios, essentially. They'll be able to see how much you own, or if you own anything, because Bitcoin or Coinbase are already working with the government, and this will be a worldwide thing, I'm sure. So it's always better to be ahead of them, because if they do prompt you, then you'll be liable to pay a much higher penalty. So that is my advice on that part, but not financial advice overall. So that'll be all for this video. A lengthy one, but a very, very important one, especially before the bull run. And on that note, I hope you got some value from that, and see you in the next video. Peace.